Welcome to the second in our webinar series on bank-sponsored systematic risk Premia strategies, sponsored by Stonebrook Capital Management, LLC. In the first session, Tashil Fakir of JP Morgan gave an overview of the industry and strategy offerings. In this session we want to go into the mechanical details, discuss some due diligence items that we think are important, and start to delve into how to determine whether strategies are sustainable or not. So, what are these strategies? Let's start with what they're not. They're not an investment in any underlying securities. You're not buying into a managed account or purchasing fund shares. Rather, when you invest in a strategy you receive the results of a calculation. That is, the strategy itself is a calculation based on the prices of some reference securities or indices, and the bank promises to deliver you the results of that calculation via a swap. A simple example is to promise to deliver the returns of the S&P 500, which is purely a calculation based on stock prices. They can promise those returns without you actually owning those stocks. They can just calculate the return of the S&P 500 on any given day, and deliver that return on the notional amount you've invested. That's why these strategies are sometimes referred to as investable indices.
At the core of every strategy is a rules document. This is both a contractual and technical document that specifies in exact detail how the strategy calculation is performed. Everything securities or index price inputs, calculations, and return or NAV outputs are described in exact detail. If you take this document and perform the calculations, you'll get the same results as the bank. This is the bank's intellectual property, so these rule documents are zealously guarded. As such, you're usually required to sign an NDA where you promise to keep it confidential. For this webinar, we'll use a public domain rules document for the ISTOXX Dynamic VSTOXX Index, which is a strategy that toggles between an implicit short position in the short-term VSTOXX Index, which is the European version of the short-term VIX Vol Index, and long positions in the mid-term VSTOXX Index in an attempt to harvest the contango roll-down of the VSTOXX curve during normal times, while protecting against losses during bouts of risk aversion when the curve shifts into backwardation. As we showed in the earlier block diagram, there are three essential components to any strategy rule: the input data, prices, indices, fundamental data, etc. The calculations themselves, and potential embedded execution costs. On this slide, we've highlighted the input data for this strategy in red. In this case, it references short-term and mid-term VSTOXX indices. We use the term references because the strategy doesn't actually trade VSTOXX indices, it simply uses their prices in the calculation. The source of input prices is an important due diligence consideration. If a strategy uses exchange-traded instruments or third-party indices like the S&P 500 or the Barclays AG, then we can take comfort in using prices from well-known, independent sources. On the other hand, some strategies reference proprietary indices or OTC instruments that the bank prices themselves. You then have to ask yourself if you are comfortable with any conflicts that may arise from that.
Here we show some of the calculations. They can be very simple or quite complex. A couple of things to point out: one is that calculations can sometimes get quite complex, not because of the math, but because the rules often reference variables that are calculated in disparate sections, making the rules difficult to follow. Or there may be nested layers of rules where the calculations use sub-indices that have their own rules document. This can go as far as 4 layers deep or even more. It's much easier to understand the calculations if you first clearly understand what the strategy is, and what it's trying to accomplish, and of course if you understand the financial instruments they're referencing and generically the calculations, such as day count conventions, etc. Also, Some strategies use third-party optimization or statistical packages that you may not have access to, so it's impossible to validate their exact results. But you might use another package that gets you similar results. Or, you can compare the returns to that of similar strategies to see if it's behaving like its peer group.
The third element of strategy rules is execution costs. Often transaction costs are built into the strategy rules calculation. These can take the form of transaction costs that charge a percentage of changes in implicit notional positions held by the strategy. Also, a flat annual fee can be embedded into the calculations. It's often referred to as a licensing fee or replication cost. At the swap level, meaning in the swap terms, you can also have in-out fees. Those are the transaction costs associated with putting on positions when initiating a swap trade, or taking it off. You will be charged this for increasing or decreasing your notional position size. Also, the licensing fee can appear at the swap level instead of being embedded in the rules. In order to hedge themselves, banks do actually trade the strategy on their books, so they do incur transaction costs. Those are passed on through these embedded costs. The key due diligence question is, are the transaction costs fair? Let's go back to our example. We see here in our rules example that there is an execution cost, EC of 0.1% of change in notional value of implicit position size. Also, there's a running replication cost, RC, of 1% per year. We'd check historical bid-ask data for VSTG swaps to determine whether those execution charges are fair. For small size, we'd consider the 1% per annum replication cost to be high, but fair.
Those are the basic mechanics of the strategies where the DNA, if you will, is the rules document which specifies the inputs, calculations, and outputs. It's necessary to analyze it and satisfy yourself that it's unambiguous, and you're comfortable with the input prices, the exact rules, and any embedded costs. This analysis is necessary, but certainly not sufficient. The ultimate question we need to ask is whether the strategy returns we see in the simulation and live periods are indicative of how the strategy will behave across the spectrum of market conditions. We think of strategies as dynamical systems where market behavior is the input. Our task is to fully characterize how this system will behave in each market environment. If these strategies had decades of simulated and live performance, then our job would be easy. But they don't. Typically, a strategy might have a simulation that goes back to 2007 or 2006, that's long for this industry, and a live record of a couple of years. Though the last decade did experience a wide variety of market conditions, it in no way represents the full spectrum of potential market behaviors. So, if we can't rely on this history, then what? There are a few things we can do. At a base level, we can make sure the strategy isn't overfit over its simulation history. We can simulate further back in time if the data is available. Also, it helps if we pick strategies driven by well-established risk premia, and we can test market conditions outside the available data using analogous markets or even artificial data.
We want to emphasize how right now this sort of analysis is really important. We're at the end of a 35-year decline in rates. The environment moving forward won't be the same, so simulation over part of this period is only useful up to a point. The first step we take when characterizing strategy behavior is to simulate it using the same data set as the banks. We then vary the parameters to ensure the strategy isn't overfit. In this slide we show how the equity curves for a strategy varies with parameters. This one is fairly robust.
It also helps if a strategy is driven by a well-established risk premium, because there's usually a large body of research supporting it that characterizes its behavior across market regimes. As an illustration of this point, here's a study of the momentum risk premium that used data dating back to 1903. We've seen other momentum studies dating well back into the 1800s.
Sometimes we'll use what we call analogous markets to estimate behavior. This graph is a study we did on trend following back in 2011. We wanted to know how diversified trend following portfolios would behave in a low flat interest rate environment, because so much of trend following's historical performance has come from sovereign debt and short rate instruments. At that time, that interest rate environment had never happened in the US or in Europe, but it did happen in Japan, where rates fell precipitously in the 1990s and flatlined in the 2000s. We ran a trend following model using JGBs and Euro-Yen over that period, and we found that, as expected, trend following, in blue, was quite profitable as rates fell, but returns were greatly muted after Tibor, in red, flatlined. We used this study of an analogous market to estimate that trend following would experience below historical average performance in upcoming years. The box on the graph shows what actually happened in subsequent years, validating our theory. Especially now, if you want to know how a strategy will behave in market conditions not in your dataset, and you don't have earlier history that contains that behavior, you can use analogous data, or even construct artificial data. We'll discuss that in a later webinar.
To summarize, these strategies are calculations that use prices of securities or indices as inputs. Every aspect of the strategy is codified and fully disclosed in a rules document that is a part of the legal contract with the bank. The key due diligence issues are input pricing transparency, the nature of the calculations and whether they can be validated, and the transaction costs and fees. The key investment issue is characterizing how the strategy will behave across the spectrum of market conditions. This concludes our webinar on bank-offered systematic risk Premia strategies due diligence. Please join us for the next webinar in the series, where we'll discuss the operational issues involved in investing in these strategies. We want to thank our sponsor, Stonebrook Capital Management, for their support. Thank you for watching.